Hello, Philip. How you doing?
I'm good. How are you doing?
All right. Good morning, Patty, or good afternoon, I guess, huh?
Yeah, it's doing good. You?
I'm dealing with an emergency here. I just dropped this Coke on the floor.
Oof.
Watch out, everybody. Okay, we'll wait a moment. Jeez, I dropped it again. Incredible. Okay. Now the professor's getting ready. Okay. Hi, Lauren. Anybody want to show their face?
In a moment, dealing with something.
Okay. Yeah, we'll go over chapter 2 in pretty good detail today. And that puts us right on schedule. Hopefully the homework, the first chapter is not too tough. Won't be too much of that on the test coming up. Okay. I'm going to share the screen. Give me a moment here. Well, okay, we should be ready in a second here. Can you all see the screen? Do you see it say chapter 2?
Yep.
Okay. So we have Lauren, Philip, and Patty. Anybody else here? We got how many participants? 1, 2, 3, 4, 5. Okay. All right. I guess we can get going here. I'm just going to set this up. Chapter 1 was a very, very brief introduction to what accounting is kind of all about. We learn it's the language of business. Companies must come up with audited financial statements if they're ever to grow their business, if they're ever going to be able to borrow money, attract investors, even good employees. You want to have the right financial information available at all times. Here we're going to get in chapter 2 a look at what's called the accounting equation and how it is impacted by some simple transactions. And in this chapter, we're going to use words like higher, lower, increase, decrease, up and down when we're talking about accounts movement. When we get to chapter 3, you will not hear those words anymore. It will be debit and credit. But let's get comfortable with the accounting equation, what's in it, and how it can be used. The accounting elements of a company. A business entity, what they're saying here is any association that gets together to try to make money is a business. And the important concept they're making here is the business entity's finances are kept separate from the owner's non-business, because in this chapter, we're going to learn about something called owner's withdrawals, where the owner takes money out of the business for his own purposes, which he's certainly allowed to do. And the owner of a business, he may have assets and liabilities and non-business. We want to keep the non-business separate, okay? That's a pretty obvious start. Okay, our accounting equation begins with assets. Assets. It's an accounting term, assets. These are items of value that we own. These are items that have value. And hopefully we're going to use these assets in the future to generate more cash, more assets, and grow the business. What are some good things companies own? Cash. There's nothing better than cash, huh? Merchandise. That's your inventory. You know, if this is Nordstrom's, those would be garments that you're going to buy for $100 and sell for maybe $300. Furniture, fixtures, machinery, buildings, land, etc. Accounts receivable. Let's talk about accounts receivable. Accounts receivable is going to be one of the accounts on your general ledger. An account is anything that you want to isolate in terms of your bookkeeping and accounting. For example, here, cash, merchandise, furniture, each of those is a separate item in your chart of accounts. Accounts receivable. Understand that accounts receivable is the amount of money owed to us at a particular point in time. If you look at your general ledger and you see that the number is $10,000, that means all your customers combined at that point in time owe you $10,000. You have sold something to them on credit. The whole world runs on credit, right? You don't drive around with truckloads of cash. So you trust that your customers are going to pay you. They've promised to pay something in the future. Assets, liabilities. A company can have $1 billion worth of assets and not be worth 10 cents because their liabilities are higher. Liability is a debt. It's what we owe to our normal trading partners. It is an IOU, a promise to pay. A liability is something owed to another business entity or to a person, and the debt of obligations are due to a past event. We bought something on credit. We're Coca-Cola, and we went out and we bought 10,000 pounds of steel from somebody to make the to make the cans. Well, when we made that deal, we promised we would pay them in 30 days. That is our liability. Accounts payable, you are dealing with your normal business partners. Notes payable is a totally different account. They're two different things. Notes payable results from you borrowing money. And now, just like we went into accounts receivable, let's talk a little bit about accounts payable. An unwritten promise to pay a supplier for assets purchased or services rendered. Unwritten promise. That's what it is. It's not a contract. When you made a deal with this company, they checked you out, and they said to themselves, okay, I can trust Lauren here to pay the bill on time, to pay the bills on time. If you don't pay the bill on time, of course they can come after you and do what they can to collect. But it's not like a note where there's interest involved and a formal contract. And don't confuse accounts receivable and accounts payable. Ask yourself, are we the ones who are going to get the money in this transaction, or are we going to eventually have to pay? All right. Accounts receivable and accounts payable, the same thing, depending what side of the transaction you are. To the selling company, it's accounts receivable. To the purchasing company, it's accounts payable. Note payable. Now, this is the formal written liability. You want to borrow money from a bank, you go in there and they say, okay, I'll give you the $1,000 you want. Sign this note. And the note says, I promise to pay back the full $1,000 in 2 years. And I'm going to pay 8% interest. And I'm going to pay the interest every 6 months for the next 2 years. That is a note payable. Notes payable have priority over accounts payable. If the company goes bad, if the company begins to go out of business and only has a finite amount of money left to pay people, the people holding a note get paid before accounts payable. That's why sometimes you'll see a company sell something to someone, then that party cannot pay. And the party says, look, can we turn it into a note? I know a year from now I can pay you. And the company will jump at that because they'll be able to collect some interest. And now they have a firm commitment for paying with the hierarchy above accounts payable. Owner's equity, huh? Owner's equity. Well, it's the amount by which assets exceed the liabilities. Company has $10,000 in assets, and the company owes $4,000 to their suppliers and lenders. The difference of $6,000 is called the net worth of the company. It's called the equity of the company. It's called capital. It's got different names. That takes us to our accounting equation. Take a look at the accounting equation for the first time. Assets equal liabilities plus equity. Assets equal liabilities plus equity. This company had $1,000 in assets. They had $200 in liabilities. The owner's equity is thus $800. That $800 represent what this company is worth on paper. It may not have anything to do with the actual market value, but on paper, that is what this company is valued at. $800 in my example, okay? And they're giving us a brief example here. If a business has total assets of $60,400 and the liabilities are only $5,400, once the debts are paid, the remaining assets belong to the owner, right? That's kind of what we're getting at. $60,400 in assets minus the $5,400 gives us the owner's equity. And there's your accounting equation again. Assets equal 5,400 plus the 55,000. Guess what? The accounting equation must always stay in balance. And anybody in the working world today should never run into that problem. No computer system like QuickBooks, Mass 90, IBM, whatever you're using, no system will ever allow you to post an entry that is out of balance. I don't think that's possible. In the old days, when we had to do this in pencil, that was always a pain in the neck. Keep that under control. Now we're going to look at a few transactions. We're going to look at a transaction. What's a transaction? Well, they're calling it an economic event that affects the business. And it normally requires exchange with an outside entity. Not always, but they're saying typical business transaction is with another company. It's with another person. And we're going to measure in dollars, of course. And all these transactions affect the accounting equation through specific accounts. A business transaction can be a sale of your product to a customer. That's a business transaction. You bought something from a supplier. That's a transaction. The electric bill came in the mail today. That's a transaction because you have to record that. So business transactions are what we're going to record into our general ledger. The general ledger meaning the books of the company. You've heard that expression, the books. What is an account? I believe if you look at your book there, if you have the hardcover of the book, they have the chart of accounts we're using in the inside cover. If you open up the cover or the back of the book, here companies choose which accounts they're going to use. Every company has a separate account for cash. We have to keep track of cash separately. Accounts receivable, inventory, accounts payable, notes payable. When it comes to expenses, you're probably going to have supplies expense, insurance expense. You might have phone expense, water bill expense, electricity, separately in separate accounts. Although some companies say we don't need to separate the electric bill from the water bill from the gas bill. We'll put them all in one account called utilities expense. It's up to what the company wants to do. So a business transactions occurred. Here's how we want you to think about it. What happened? Be able to articulate in words what just happened. And that'll be a big step in the right direction. What happened? Well, we just sold some product to our best customer. We sold $100,000 worth of staplers. That's the transaction. Well, if we did that, what accounts are affected? Well, he's going to pay us later, so there's no cash. So I know accounts payable is good. And since it's a sale, it's going to be part of our revenue. So you determine what accounts are affected, which ones went up or down, making sure the accounting equation stays in balance. Now we're going to show some simple transactions and how they affect the accounting equation. And this lecture will be a success if you come out of here feeling fairly comfortable. You understand what the accounting equation is and how it gets moved around through some transactions. Okay, let's analyze a few. All right, put your seatbelt on. Here we go. We're finally seeing some numbers. Mitch Williams invested money in a business. Transaction A, investment by owner. Mitch Williams is the owner. He started a business. He took $5,000 out of his own bank account and he opened up a banking account for the company. He opened a company bank account. He put the money in that bank. That's a transaction. And all transactions have two elements. All transactions must have two accounts, minimum, okay? So what are the two accounts that are involved here? Well, he put money in the business, so that's cash. Well, and that must mean the business is worth $5,000. That's all he has. He has no liabilities yet. So they're taking you through this process here. Cash is an asset, capital, that's part of owner's equity. Cash went up, and so did the capital. So let's take a peek at your accounting equation. And there it is to start. Pretty simple, huh? There was no business before. Now he put $5,000 into the business, and the business is now worth $5,000 on paper. Well, he's got a business now. He delivers pizzas, this guy. So he needs some delivery equipment. He went out and bought some scooters or something, huh? And he paid in cash $2,000. Well, let's see here. What accounts are affected? Well, cash is certainly going to go down, right? Cash will go down. He bought this stuff for cash. And he's got an account called delivery equipment. That could be just called equipment, but he might have an account called delivery equipment. He might have oven equipment if he's making the pizzas. You have different accounts. So cash and delivery equipment are both assets. So what we really did was exchange one asset for another. We bought equipment for 2 bills and we paid cash. So now take a look at your accounting equation. The cash has gone from 5,000 down to 3,000, but we still have the same number of assets because another asset went up to offset that, and our accounting equation is still in balance. We bought an asset on account. You know what on account means, guys? On account of nobody had money. As soon as you see the words on account in a transaction, say to yourself, no money, nobody had cash. So you know cash is not part of this transaction. On account, it can only be accounts receivable or accounts payable, depending how your ox is gored, okay? So we bought delivery equipment on account, on account. Well, we're the ones who are going to have to pay for this. So that means we brought in delivery equipment, which is an asset, and now we have to increase a liability called accounts payable. And they're taking you through this long-winded method of thinking about it. The delivery equipment increased, AP increased. Here we go. Here we go. We have more delivery equipment, so our assets have grown from 5 to 6,800, right? The business is still only worth the 5,000. What changed? The accounts payable went up, and we are still in balance. Assets equal liabilities plus equity. Anybody have questions, or I'm going too fast with my New Jersey way of speaking? You guys jump in and say, hey, slow down a little bit, buddy. Payment on a loan. Remember, we just bought that equipment for $1,800? Well, maybe the deal was we're going to pay it back once a month for 3 months or something. So now we're paying for the scooter we already purchased. We're paying for that delivery equipment. So when you see the word paid, you know that that means cash. Cash means paid. So our cash is an asset and accounts payable is a liability. And let me just take a snort here real quick. Cash is going to go down, and so is accounts payable. Oh, that's good whiskey. So let's just take a look at the transaction here. Notice what happened. Cash decreased by $600. We only have $2,400 left in the bank, but at least we don't owe $1,800 anymore. We only owe $1,200, and we are in balance. Now we're going to introduce something else. We said that the accounting equation is assets equal liabilities plus equity. The things that affect equity are going to be revenues, meaning sales, expenses, and something called drawing. And we're going to talk about that now. Revenues, it's what you charge customers for the products sold or services rendered, okay? Recognized when earned, even if the cash has not been received. And that is so very important. You sold me $100,000 worth of products on December 31st, okay? December 31st. Your truck left your building on December 31st. That sale belongs in your December financial statements, even though I'm not going to pay you probably until February. And that's important to understand. You recognize your revenues and you recognize your expenses when they're incurred, when they happen. So in this case here, you have delivery fees is a revenue, consulting fees, sales, revenues, sales. The expenses are the offset to revenues. Revenues or sales minus expenses is your net profit. You don't have to go to school or college for that, but that's what we're getting at with these different terms here. Expenses, this is the rent expense, the salaried expense, all those things. And once again, it has recording the expense has nothing to do with the cash movement. For example, you received the electric bill in the mail on December 19th or whatever it is. And you say to yourself, wow, yeah, that's the electric bill, all right. That's about right, $1,000. You're not going to pay that electric bill for 30 days, though. But that expense belongs in the month where the electricity was consumed. The accounting period concept, we talked in the first chapter about generally accepted accounting principles and generally accepted process and procedures. I'm sorry, I get a little cramped there. One of the terms in that, in generally accepted accounting principles, was what I was trying to say. They have something called periodicity. Periodicity. What a word that is, huh? I've never once used that in a sentence other than studying. It simply means the concept that a business is an ongoing concern. You know, it's like a shark. It just keeps going through the water. But every month or so, you can analyze what happened in a particular month. You can break the business down into a period of a year, if you wanted to analyze a year, or a quarter, or a month, the period concept. And every business in the world that I've ever seen, they go through what's called a closing process at the end of each month where they produce their financial statements for the world to see. Okay, this one's not too tough, I don't think. Net income. Net income. You have net income if the revenues are more than the expenses. 9 million in sales, 5 million expenses, we made money. Here, this poor guy here, revenues were say 3,000, but the expenses were 5. He lost 2,000. The person who had made the money, this $4,000 profit here, that $4,000 at the end of the month is going to increase your equity. The $2,000 loss is going to decrease it. Decrease it. Now, here we were talking a little bit about the need to keep the personal business away from the regular business. Withdrawals or drawing, you call it drawing. The owner takes cash from the business for his or her own use. When that happens, the cash obviously goes down, and so does the equity of the business. Withdrawals are not an expense. It's a reduction in what the business is worth. So you're working in the accounting department, and your boss comes out to you and she says, Philip, can you write a check, please, for $1,000? And you're the accounting guy, so you have to ask what it's for. Obviously, say, yeah, sure, boss. Where do I code this? and you say, I'm taking my family down to Disneyland for the weekend. Well, as soon as you hear that, you know it's not company business. That's a withdrawal. So let's look at, we'll get to a withdrawal shortly. Here, we're looking at the expanded accounting equation. And let me know if you can't read the numbers. My eyes are not the best. I'll assume you're able to read these numbers unless you tell me otherwise. So let's look at our accounting equation. Assets equals liabilities plus owner's equity. But now look at the components of the owner's equity. I see four things there. There are four things involved under owner's equity. One is the capital we started with earlier. Mitchell put 5,000 in the business, and now that capital is going to decrease if there's a drawing. It will increase with every sale and decrease with every expense. At the end of the month, we're going to gather up all those revenues, all those sales and drawings, and come up with the new accounting equation. Revenues will always increase the equity of the business. Expenses will always decrease it. Okay, now we're getting into some transactions that are in what we call the income statement, okay? Mitch finally delivered some pizzas. How about that? He delivered some pizzas and he received $2,100 in cash, okay? So let's see here. What are the accounts that are affected? Well, he got cash, so we know cash is going up, and his sales went up. His revenue went up. His equity went up with this. So let's take a look at the transaction. And there it is in blue and green. Notice that the cash is now increased to $4,500. The total assets are $8,300. Now take a look under owner's equity. Remember, it was $5,000 to begin with. This revenue added $2,100 to it. So we are in balance now. We are in balance. I see a misprint there, but I'm not going to worry. I'll confuse you if I correct that. Okay, now we paid the rent. Here's an expense. What happened? I just opened up the mail. I'm looking at the rent check from the property manager. Okay, well, we're going to have to pay it. So let's pay it right now. So we paid it. Cash is going to go down. Cash is going to decrease. And so is owner's equity because of the rent expense. Here we go. Cash went from 45 to 35. Look at our equity now. The capital is still the same, the capital portion. We haven't had any drawings yet. Now we have our first expense. Our first expense, $1,000. And notice that they're telling you what the expense is off to the right under the description. That's crucial because at the end of the month, we're going to have to list every expense line by line what it was. And our accounting equation is going all over the place, but we're still in balance. Look at this. We got the phone bill too. Oh my goodness. The phone bill came in. And now we have to pay the phone bill. Well, again, cash is going to go down, and an expense called telephone expense or phone expense is going to go up. Is going to go up. Our equity, of course, is going to go down. And if you look at the expenses over here, we've added a second one now called phone expense. Our expenses have grown from 1,000 to 1,100. If the company ended the month at this point in time, this company would have a profit of $1,000. The 2,100 minus the 1,100. All right. Now we delivered some equipment on account. On account, and nobody had money. On account is there's no money involved. So we know if it says on account, it's going to be accounts receivable, meaning we're going to receive the money, or it's accounts payable, we're the ones who are going to disperse the dough. So what do we have here? Well, obviously, we sold something, so we're going to collect $2,400. We're just not getting it right now. So our accounts receivable, the asset went up, and so did the sales, the delivery fees. So did the delivery fees. And here it is. Delivery fees, which is what they're calling their revenues, went up by 2,400. And accounts receivable went up 2,400. When we get paid later, we're going to take that $2,400 and move it into cash and get rid of the accounts receivable. Okay. And again, revenue is recognized when it's earned, even though the cash is not moved yet. Okay. Very important concept. Now we bought supplies. And they're making a note here, supplies should last for several months. That just means that in our book, when you see the word supplies, supplies is an asset. Supplies is an asset until you use the supplies, okay? The expense is called supplies expense. The asset is called prepaid supplies or supplies. So, okay, we purchased an asset called supplies. Well, that's going to go up, and we paid it in cash. We paid it, right? Yeah, we paid cash. So here you go. Here's a new asset, supplies. Supplies went up, but it cost us $80 in cash. Supplies is a prepaid expense account since the supplies will be charged off to expenses when they're concerned. That's a chapter 4 item we'll be getting into, the prepaids. Hey, remember that guy we just sold some pizza to? We sold like $2,400. Looks like he's paying a good chunk of it now, huh? We're getting cash for delivery services performed earlier in the month. Notice that equity is not going to be affected by this now. Here, what's going to happen is our cash is going to go up and the accounts receivable goes down. We received $1,900 from this guy, so he does not owe us the $1,900 anymore. He paid part of his bill. And notice there's nothing here except the two assets. Cash went up $1,900. Accounts receivable went down $1,900. Revenue is recognized when earned, not when cash is received. You're getting the sense that's a pretty important concept we have to drill into ourselves. All we did here was exchange one asset for another. There was no other activity along the accounting equation. Now we're buying something on account. On account, so we know it's accounts receivable or accounts payable. Well, as soon as we see the word purchase, we're pretty sure this is what we're going to be paying. So this is definitely an accounts payable item, huh? And he bought a scooter for $1,000. But look at this. He made a down payment, it looks like, of $300, and he's going to pay the remaining $700 in the future. So now we're looking at our first 3-line entry. Every entry must have two. Must have two. That's why it's called double entry accounting. So you can have 2, 3, 4, up to an infinite number. So let's see what we got here. Well, let's start with the equipment. That's what we bought. The equipment is $1,000, right? So that's going to go up. We paid $300 in cash. So cash is going to go down. And now we owe $700. So the liability increases. And we'll take a careful look at this now, huh? Delivery equipment. He purchased $1,000 worth of equipment. So that is increased by the $1,000. He made a down payment of $300. So cash goes down. We owe the difference of $700 in accounts payable. The accounting equation remains in balance. The accounting equation remains in balance. On this transaction, we had plus 1,000 minus the 300, 700 equals 700. We are still in balance. Now he's paying the insurance premium. This is another prepaid asset you're going to learn about. It's an expense, but believe it or not, it's called a prepaid expense or a prepaid asset. When you buy insurance, you're buying it for the future. So the day you buy the policy, it's an asset. It has great value. It protects your company. If you bought a policy in the middle of December for next year, that insurance does not give you any coverage until January 1st of the new year. So you, even though you might have even paid for it in the month of December, if your business burned down, God forbid, you'd have no insurance company in December. If it burned down on January 1st, two things would happen. You'd have insurance coverage, and you'd also have an insurance investigator come and find out how the business happened to burn down the first day of the coverage. But I think you get the idea. So what happened here? Another exchange of assets. Prepaid insurance went up, cash went down. Notice now we've developed different kinds of assets. We started with just cash. Now we have accounts receivable. Customers owe us money. We have $80 of supplies that we bought, but we're not going to use for a while. Same thing with the insurance. We're not going to use that just yet. Aha, here's a big expense. Mitchell has to pay the people delivering the pizzas. And guess what? Wages or salaries and wages is an expense. It's an expense. So the expense is going to go up. Cash is going to go down. Expense goes up. That means that your equity goes down. Expenses automatically reduce your owner's equity. Assets equals liabilities plus owner's equity, right? So here the cash decreased and the expense increased. No liabilities involved here. And there it is in blue and red. Cash has gone down to $2,570. The expenses have now grown to $2,750. Okay? So a lot of action going on here with this company. Now here, we're on the other side of the on account. Here, we are making a delivery and we received a partial payment. So let's see, we delivered the pizzas. Aha, that's accounts receivable since we are the ones going to get paid. So let's see what we have here. Let's divide and conquer. Well, we know we're going to have cash involved, accounts receivable. We know we have sales, delivery fees. Let's put some numbers to them. The delivery fees, the amount of pizzas we delivered was $3,500. That increases the owner's equity. We made a cash down payment where our customer paid us in cash. One of our customers paid us in cash. So cash goes down and the customers owe us the difference of $2,600, which goes up. So here's our transaction. Revenues, $3,500. Right now we have revenues of $8,000 against expenses of $2,750. So this is a remarkably profitable business so far, okay? And our cash is now grown by $3,470, and so has our accounts receivable. Withdrawals. Let's look at this now. You're seeing this for the first time. Mitch took $2,000 out of the business for personal expenses. This is probably the way he's going to pay himself. If the business is going good, he'll take a few thousand out for his own salary. Identify the accounts that are affected. Well, when he took money out of the business, that's cash. So cash decreases. And because drawings are personal business of the owner, when he takes money out of his own business, he has reduced the value of the business, the net book value, also known as equity capital. Okay, net worth. So look at this carefully. We decrease the cash, we increase the drawing, which has the effect of reducing the capital. The capital at the beginning of the month was $5,000. And then we had sales of $8,000. So that's 13,000. But then we had these expenses here, which dropped the number down. So look at the capital one more time, please. Your capital plus revenues and expenses. Another way to say it is capital plus net income minus drawing is your new balance. Withdrawals by the owner reported in that drawing account. It's the opposite of the investment. Think of it that way. Remember our very first transaction, he put 5,000 in the business. We increased cash, we increased equity. Now he's pulling out 3,000, which has the opposite effect. The drawing account will increase, but it causes a decrease in the overall equity. Hey, we've just gone through some transactions. Let's look at the product of the transactions. What are we going to show to the world? We're going to prepare 3 financial statements now: an income statement, a statement of owner's equity, and a balance sheet. Let's learn about all of those, huh? There are 3 commonly prepared financial statements: income statement, statement of equity, and the balance sheet. Keep in mind, they must be prepared in a particular order. You must do the income statement first. You must do the statement of equity second, and finally the balance sheet. You can't possibly do them in any other sequence, as hopefully we'll learn now. So you're making up, you're doing your financial statements. The header on top of the page is always going to be the name of the company, Mitch's Campus Delivery, and then you say income statement, and we'll say for the month end, June 30, 2025. Does that say? My goodness. For the month end of June 30, 2025. You ever hear that song? In the year 2520. You guys were not back in the Woodstock era. Okay? So you put for the month end. That'll be your header. This sheet here, I'm going to kind of skip. They're giving you advice on what to underline, what not to underline, and I'm not too interested in that. Take a look at your income statement. I hope you can all read this. I'm assuming you can read it. If I can read it, you can read it. The income statement reports the profitability of the business for a specific period of time. There's that word again, periodicity. I don't even know how to pronounce it. Revenues are subtracted from expenses to get your net income. And you can also call this the P&L statement, profit and loss, the operating statement. So let's look at how this was presented. Well, they started off with a category called revenues, and maybe this business has different types of revenues. In this case, they just had one so far. So they have revenues, and then they indent, and over to the far right, they put down the revenues, $8,000. Then they list all of the expenses after a heading called expenses with a colon. You list your 3 expenses, maybe put them a little bit to the left of the sales number. You add down your expenses to get your total expenses, and there's your profit. This company made a profit of over $5,000 on sales of just $8,000. That means that they took back over 60, that's about 64%. That's pretty good. If Mitch had said, I'm not going to take the risk of starting a business, I'm going to put the $5,000 in the bank, he would walk out with maybe $1.50 at the end of the month under today's interest rates. Now, where did we get these numbers? That's correct. You're saying to yourselves, we got them from the accounting equation. Here are the sales. Here are the expenses. And then if we want, we can pick the expenses out one by one. We had wages expense. We had wages expense. We had phone expense. And we had rent expense. So the numbers are coming right from your accounting equation. Any questions on the income statement? Investors will come in now. You've got this business and you are hoping to issue stock to the public and you want to raise money. You can proudly show this financial statement. Now, here's an important point. The reason we did the income statement first is as follows. You cannot do the equity statement without doing the income statement. because the equity statement is the right side of your accounting equation after liabilities. So let's take a look at this. Your beginning balance was nothing. He didn't have a business. Then he put $5,000 in the business. So the equity went up. Then he made that profit of $5,250, which we just calculated on the income statement, which is why you have to do the income statement first, because the income is going to go transfer over to the equity statement. But then he took $3,000 out for his own personal use. So 5250 minus 3 is the 2250. Equity at the end of the period is $7,250. Okay. So let's take a look at that. You had the investment, original investment, plus the income minus the drawing. And again, that comes right out of the accounting equation. Here it is right here. 5,000 at the beginning, plus revenues of 8 minus 2750 gave us that remarkable 5250 in income, minus the 3,000 gets us down to 7250 is your equity. Now, the reason we have to do the equity statement second is because we need to take that new equity number and roll it into the balance sheet. Let me point out something important. Look at the heading. You notice the heading for the income statement and the heading for the equity statement both said for month ended, for the month ended. You cannot use the words for the month ended on a balance sheet. A balance sheet is a snapshot in time. A balance sheet simply is taking a picture of how much cash you had at the end of the month, what your receivables were. It's also called the statement of financial position for that reason. Okay. So you can't say for the month of or something like that. You must say a specific date. The best way to say it is as of June 30th, 2025. Okay. So let's take a peek at our balance sheet. The balance sheet is pretty much just a representation of the accounting equation. So if we know the accounting equation, assets equal liabilities plus equity, the balance sheet lists all the assets on one side, and on the other side, it lists the liabilities and equity, and hopefully they match. And they do. Our total assets are $9,150, and the total liabilities and equities $9,150. Again, where did we get these numbers? Well, the 7250 we got from the second statement, the equity statement. Where did we get this 1900? Where did we get this 470 for cash? Again, it goes right back to the accounting equation. Here it is right here. 470, 3100, 80, 700, 430s. You go 430, 3100, 80, 700. So now this company has prepared their 3 financial statements. They can now announce to the public, if this was a real big corporation, man, oh man, they would have a big press conference and they would say, Mitchell's Campus announces profit of $5,200 or 64% on sales. We did great, you tell the world. And then you show the equity grew by 7250. And here is your balance sheet. We're just copying everything from the trial balance, or what we're calling the accounting equation now. 3 phases of the accounting: input, processing, output. Last night, a few students came to me and for tutoring. And I'm the teacher, and I should know my stuff. And they asked this question: what are the 3 basic phases of accounting? And I drew a blank on it: input, processing, output. So let's just look at it. It's worth a point or two on your test. The 3 basic phases: input. The transactions are the input, not the entering it into the system. The transactions, by definition, are the input. The processing is knowing what we're going to do with these transactions and getting them into our general ledger, and the output are the financial statements. And that takes us to the end of our presentation. Who do we have here? Hey, Sarah, what do you think? Got any questions? Is Sarah there?
Not so far.
So far,
It's
so
all
good.
making sense.
Okay, that sounds good. How you doing, Philip? You okay with what we've done so far?
Yeah, I'm all good.
Okay. Hi, Patty. Nice to see you again. Doing okay?
Yeah, so far.
All right. And who else do we have here? Oh, Eric, my man from San Bernardino. How you doing, Eric?
Hey, pretty good. How you doing, Bob?
All right, Eric, do you want to make a motion to end the meeting?
Sure. Motion ended.
I second. No questions, anybody? Okay.
Not yet.
We're all good.
Okay. All right. Well, you guys take care. I'm here tonight if you want to, come in and chat and go over whatever you like to do. Okay.
Okay.
If I don't see you, have a good weekend. All right.
All right.
Thank
Have a
you.
good one.
Bye-bye.
Bye-bye, all.